Hey guys, what is happening and welcome back. So in today's video, we're talking about the real estate market, but we're talking about it in the sense that is the real estate market becoming akin now to gambling, just like the stock market has become. So before we get started, guys, please hit the like button, please subscribe to the channel if you haven't done so already. I have a podcast which is on Spotify. I will leave the link below. I'm also on Instagram, Twitter, you name it, I'm there. All the links in the description. So without further ado, guys, let's do this. Alright guys, so first of all, let's talk a little bit about the gambler's fallacy, because the gambler's fallacy is really what we're talking about when people are just essentially gambling, but the psychology behind this simply means that people believe, like if I go to a casino and I bet $100 on red wins, and then I continually bet $100 on it, expecting the same outcome. That is the gambler's fallacy. Or it could be I go to a slot machine, I pull the lever, nothing happens, pull the lever, nothing happens, pull the lever, nothing happens, and I start to believe my odds of winning are going up the more times I pull the lever and lose, so I'm going to increase my stake size. All these things are the gambler's fallacy. Now, the thing is, this relates a lot to real estate more than you think, because one of the common arguments that I often hear people say, and you have to listen to the other argument why people think prices will forever go up, otherwise how are you unbiased? You cannot just be biased and think, hey, the housing market is in a bubble, but I'm not going to look at the other arguments, see what data they're using, see how they're arriving at this conclusion. Well, I do that. And one of the common things that people often say is, well, lots of people have predicted it and it hasn't happened, so prices are just going to continually go up. Or another way of putting that is, well, you know what, I've had so many people tell me not to buy a house, and then I bought a house and the prices just continually went up. So in a lot of cases, it sounds like the other people have been proven wrong. But the fact is, they could have just been early, and most likely were early. Because let's face it, Canada has been an extreme example of a bubble. And what people don't realize about that is it's going to be an extreme type of collapse, because if you've got an extreme bubble, you're going to have an extreme collapse. And the collapse is going to be even more catastrophic than the financial crisis in 2008, if you can imagine. And the only way that the bubble is allowed to continually get bigger and bigger and bigger is if, one, wages that people earn go up at a faster, more rapid rate and catch up, and there is such a large gap in between wages and the cost of living and the cost of housing and everything like that. It's never going to happen, guys. So you can pretty much throw that one aside. The other thing that can keep the bubble going is artificial government regulations. They could bring in 40-year mortgages. They could just essentially kick the can down the road. Anything that allows credit expansion to continue will just make the bubble bigger, and it will prolong until we get the collapse. And you have to realize that, because, you know, the thing is, guys, with any credit bubble, you have to realize and hang on a second and think that it's credit. It's not housing. It's actually credit. Credit is the problem. A housing bubble, yes, you can call it a housing bubble, but on a larger scale, it's a credit bubble. And the credit bubble relies on credit, money flow being easy and there for people. So if interest rates go up, let's say the Scotiabank scenario of 4 or 5 rate hikes happen next year, and we saw that happen, Well, unless the government came in and said, we're lowering the stress test, which boosts, again, more people can then get credit. It means people can afford more than they could. If that happens, then yeah, you're going to see prices probably stabilize or continually flatline for a little while. But here's the thing. Let's say everything remains the same, or the conditions of credit and everything that we have now remains the same, and then that Scotiabank situation happens. Well, that's a different scenario now, because with that, it's totally different. And it means that essentially you would have it contracting. So what people could afford is actually going down, because wages probably aren't even going to keep up with inflation. They're already screaming behind inflation from last year, so it's just going to compound now and get worse. So affordability is just getting worse without interest rates going up. When interest rates go up, guess what? That worsens the amount that people can afford, the credit that people can get hold of is much less. So that means the credit bubble kind of contracts. It means people are more likely to pay down debt on whatever. Now, the thing is, it's got to be substantial, guys. If we don't get up to 2%, I really don't think that we're going to see a massive, massive crash. I think maybe at 1% you'll start to see the market cool significantly. And then as we head towards 1.5%, you should see prices should be turning by then. And that's just due to the size of the credit bubble. And remember that people who took out these variable rates, they'll be feeling the crunch, and that was a lot of people. And that's really what we don't know yet, is just how the extent of the amount of people that took out these variable rates, how creditworthy are they? How are they going to cope with high inflation, rising costs, and then mortgage payment, the interest rate going up? And the other thing is, if mortgage interest rates on the fixed level, the people with fixed variable rate loans, essentially when they come to renewal, they can be absolutely destroyed, finding out that they barely paid anything towards the principal of the house. And then if the house has gone down in value by the appraised value, then guess what? They owe the bank the difference to get the financing again. So it can really end up in a sticky situation. And one thing I would say to a lot of people that are kind of saying it's never going to happen, lots of people have sat here and predicted that, hey, the housing bubble's going to end. I would say this to you. The fact is, yes, you're right. A lot of people have come out and they've said, yeah, the housing bubble, this and that is whatever. But the fact is, guys, we've never been in a situation before where we have such high inflation at a core level. And that's not just here in Canada. That's in the US, the EU, it's also in the UK. And it's kind of crazy. In fact, it's absolutely insane, because places like India, which have been boosting up their gold reserves, have actually seen less inflation than places like Canada and America. So to say to the fact that this is a supply chain issue and it's all just caused by that, that is definitely part of the issue. But that aside, there is a much bigger issue, which is consumer credit. And really, guys, it's scary where the stock market is. That, I think, is the most scary thing about this whole situation of this credit bubble, because valuations don't matter anymore. We saw the Q3 2021 earnings season come in throughout November and December, and earnings disappointed on many different big, large companies, things like Apple. It was slowing down. And that is a worrying sign, because eventually you get to a point where those stock prices can't keep up anymore, because the growth just isn't there anymore. And the growth expectations that people have built into these stocks is just unsustainable. And when it really comes down to it, things like Apple products, those are going to be the first thing that people cut back on and they'll go and buy a cheaper phone to save a little money if they're under the thumb of inflation. So you have to realize, guys, that the stock market is in a really precarious place. And I think it's really dangerous because a lot of the lending that we see today is dependent on the stock market being in good health. And a lot of you will probably say, well, if the stock market crashes, Luke, then that means that we're going to see the government come in with lots of quantitative easing, QE, and all the rest of it. But here's the thing. If inflation is going rapidly higher, which it looks like it's in no slowdown right now, then I think the government isn't going to be coming in and doing quantitative easing and everything like that, because they never have done so in the past when we've seen inflation like this. And that's the difference, guys. This bubble started in the early 2000s, and we've seen low inflation since then. But now we're going into high inflation that we haven't seen since before the 2000s. And we know for a fact, before the 2000s, housing prices around the world were a lot more choppy. And you can say, well, big companies are going to come up and buy all the real estate. Again, I disagree with that, because that is dependent on easy money, easy credit. And if interest rates are going up, suddenly the margins that people need to make it financially viable to do that just don't exist anymore, especially like places in Canada where most big cities, in fact, I don't even know one big city where you could buy a house and rent it out for more than your mortgages. And if you do know, then put one in the comment section. But from what I've seen and studied across Canada, there isn't any. Maybe there's some small cities on the far east coast, but other than that, I don't know. But anyway, guys, if you haven't done so already, check out my podcast on Spotify. I've also got Instagram, Twitter. The links will be below. Please give this video a thumbs up. Please subscribe to the channel for more of this type of content. And I will see you in the next video, guys. Peace and love as always. Bye-bye.